Hey, what's up, my friends? So in today's episode, right, I want to share with you how do you trade counter trend trades, right, safely and profitably. Okay, so before we get started, right, let me just explain briefly what's the difference between counter trend and catching a falling knife. Because to many of you, you might think, hey, Rayner, this is all the same thing, right? Catching a falling knife, counter trend trades, yada yada. So catching a falling knife, right, to me, right, my definition is that, let's say a stock, right, it keeps heading lower and lower with no end in sight. So it just keeps going down, and every time it breaks a new low, that's the all-time low. The next day it breaks a new low, that's an all-time low, okay? On the other hand, counter trend trade, right, for me, the way I define it is, let's say a stock, heads down lower, and maybe form a new all-time low. Then the next day, or the next 1 week, it had a huge rally. Maybe it's a dead cat bounce or whatsoever. It had a huge rally off that all-time low, right? And then later, the price is heading down lower again, about to retest the previous all-time low, or rather the previous swing low or the all-time low that it has done previously. So at that point, right, as it approaches that all-time low level, that could be a potential counter trend trade, because now you have a frame of reference, a point where you can refer to, right, to plan your trade. Unlike, right, catching a falling knife where you don't have this frame of reference because every day the market just keep collapsing lower and lower. So that's the key difference, right? Counter trend trade, you have a frame of reference, a reference point where you can time your entry and manage your trade. But catching a falling knife, right, that's not possible because the market keeps collapsing day after day, or in the opposite direction, it just keeps, rallying up higher and higher each day. Alright, so to trade counter trend, right, first and foremost, number one, you must have a point of reference. It could be an all-time high, it could be a multi-year high, it could be a 52-week high, it could be a key support resistance area, whatsoever. You must have a point of reference that you can refer to. Number two, you want to see a strong power move, right, approaching your point of reference. So let's say for those of you who trade currencies, euro dollar, maybe it had a dip right down to an all-time low at, let's say, 90 cents. Then it had a rally, a 500 pip rally, and then now it's heading down lower again and approaching, right, the 90-cent level price point. Okay, so when it approached that 90-cent level price point, you want that move, right, to be fast and furious. You want to see the candle, right, to be big and bearish. The more bearish it is, right, the stronger the momentum it is, the better. And why is that? Because that's going to entice short traders, right, to short the breakdown when it breaks let's say breaks below the 90-cent level, which is an all-time low, right? Many traders will get excited to short the markets, right? It's so bearish, right? Look at the downtrend, right? Let's short this market to nothing. So that's the thought process of many traders around the world, right, as they look at this bearish price action on the charts. And here's the thing, right? As a lot of traders pile into this short trade, right, and imagine if the price breaks below that all-time low, right, and the next thing you know, it does a false break. So that's the third thing we're looking for, a false break. So the meaning the price breaks below the all-time low on euro dollar, and then reverse back in the opposite direction and close strongly, right, for the day. So at this point, you can imagine, right, that those traders who chase to short the breakdown, they are now in the red, because imagine you short the lows, market reverse 180-degree reverse against you, you're now in the red, you're suffering losses. And this is where a counter trend trader can step in, right, because the market has signaled to you that it tried to break below that all-time low and failed. Instead, what it did, right, is it rallied higher. So a counter trend trader can come in and step in, right, and go long, right. And this time around, it's not, say, reckless trading, because you can use that swing low that is just being formed, right, to set your stop loss. You can just set your stop loss below the swing low. So if you are wrong, if the trend continues, boom, right, you're out of the trade. But at least now you have a level, right, that you can reference to enter and exit your trade. So that's what you're looking for, right, a false break. So fourth thing we are looking for is setting a proper stop loss, and it's quite simple, really. Just set your stop loss, right, below the swing low, because there's no reason, staying in the trade any longer if your swing low is broken, because likely, right, the downtrend will continue and you want to get out of the trade. And the fifth and final thing is that as a counter trend trader, let's say you enter on the false break at the all-time lows where, it couldn't hit lower. So what you want to do is to have a conservative target. Don't aim for like for the stars, for the moon, the next 2,000-3,000 pips, right? Because what happens, right, more often than not is that what you're going to get is a brief rally, right? Maybe the market rallies another, 200-300 pips, right? Exhausts itself and then collapse lower and the downtrend resumes. That's usually what happens. So as a counter trend trader, you're not trying to, get everything, right, the entire buffet. No, you're just trying to get just one small bite, right, and that's it, and you get out of the trade. Okay, so this is how you go about trading counter trends in the market. You can apply this to currencies, to cryptos, etc., right? This concept, right, would work, right? So as a quick recap, let me share with you what we've just discussed, right? Number one, right, if you want to trade counter trend, you must have a point of reference, right? Don't catch a falling knife. You must have a all-time low, a 52-week low, a multi-year highs or lows, right, to refer to time your entry, and your exits and your stop loss, etc. Number 2, right, you want to look for a strong power move into this point of reference. Number 3, look for a false break. Let the price take out, let's say, the extreme lows, right, only to get rejected and close higher for the day, right? Number 4, set a proper stop loss, right? It can go just below the low of the false break candle. And number 5, have conservative target. Don't aim for the stars because it's unlikely you're going to catch the start of a new trend. What's likely to happen is you get just a brief pullback, a short rally before the downtrend continues. Make sense? So with that said, I wish you good luck and good trading. I will talk to you soon.